Hello, welcome back. If you have been a subscriber in this channel, you know that we are not about diamond hands here and hyping up stocks. We don't do that. We do want to be making sound financial decisions and investing decisions, and this is why we're actually operating on data and we're not operating on sentiment and basically looking around, seeing stock tweets, Reddit, and be like, okay, you have to be diamond hands, buy GameStop, and all that. I only buy companies that are worth it based on what they're doing financially, and I definitely advise people to do the same. Now, your analysis could be different than mine, and obviously, any investment decision in yours is yours to take at the very end. But in this video, I wanted to, and all the other videos that I make really, I wanted to at least provide you with the tools to understand what is going on with a company in case you are not aware or of techniques on how to analyze a company, and that can actually help you make better investment decisions. And even if you haven't thought about these points yet, it may be beneficial for you to at least take part in the discussion. So, what's been going on with GameStop here is a company that has been enjoying a massive short squeeze about a year ago when a lot of institutes that were holding the stock were squeezed out of their positions, and we had a massive influx of new buyers and an increase in price over here. Now, the company is sitting at $6 billion of a market cap right now and a short interest of 15%, which has been actually going down lately because of the stock price going down as well. So a lot of shorts have covered positions. It looks like the outstanding shares of the company are 80 million here, with a very low float and a very low outstanding shares count. And the company has actually, for the most part, buying back shares and not actually issuing shares, which is a little bit weird to say, but I guess it's good for investors. Okay, so the company has also lost about 65% from its previous highs, I suppose, last 1 year. But this has happened with a lot of companies, and it's not a measure of whether the company is a good purchase or not. What is a measure of that is the financial statements. And the first one to look at is going to be our income statement here. And we're taking it back to about 5 to 6 years. And you will see here that the company's revenues have been in danger here, and they have been going down. So the company is unable to sell as much as they used to sell back in 2018 here. Yet in the last 12 months, they're doing a little bit better and going back to positive revenue growth, which is good to see. Now, the net income of the company is in the minus, even though it seems to be increasing now, it's still in the minus. Their last positive net income year, which is profit pretty much, was 2018, and from that it went really south here. And regardless of that, the stock price was going higher and higher because of the massive short squeeze. So bear that in mind, the company is still a profit negative here. The balance sheet of the company, we are looking at decreasing total assets, as you can see, from 5 billion to 3.7, although increasing from 2020 and 2021. So that's at least a good thing. The total liabilities of the company are sitting at 2 billion, pretty much most previous years were at similar levels. And as we scroll down here, you will see that the total equity of the company has been decreasing from 2.2 billion to 1.7 billion here. And it used to be 436 million in 2021. So I'm wondering what caused this kind of increase here. We can probably discover that, looking at the additional paid-in capital. So this is capital that came in from investors, really. So people bought the stock and they are funding the company's total equity here, because this is the only thing that led to an increase, really, for the company's total equity. Yeah, so the company decided to start selling shares, and I guess start diluting investors a little bit finally. And this is what happened. They increased their total equity. So it's not about the profitability. It's about the equity being increased because of new people buying GameStop shares, new issued shares. And the cash from operations is negative in the last 12 months. It was positive in 2021. But it's close to zero, and maybe minus 200 or plus 200 or so, about that. And the cash from financing here is in the negative for the previous years, but now, as we already just showed, it's the company issued shares, and so now it became positive. So they seem to be getting some money from investors, and that would be you if you're purchasing the shares. So the free cash flow is in the negative again. So the company has little capital expenditures, I believe, and so let me find the line here. Yep, 68 million, and they are basically losing 220 million in free cash flow in the last 12 months. So that's not a good picture. The multiples of the company are low because the enterprise value is actually low in comparison to sales. That's a good thing to see, of course. It points to a cheaper company. Yet the profitability is in the minus, so the company is not really making any return on equity here, or total capital, common equity, these are in the negative. The solvency ratings here pointing to a company that doesn't have too much debt, but remember that they increased their equity because they issued shares. So previously it was at 239. This 1.7 billion that they got from stakeholders brought the total debt to equity down to acceptable levels. But you really have to realize why that happened, and that's the very important thing. And this is why we do this analysis, to discover what's going on with the financials, and that paints a story here. We know what's been happening with the company, really. So we're going to go to the stock evaluation tool, and this is very handy here because it quickly gives me a picture of what has been going on with the growth of the company. So the company has been negative in terms of revenue growth. The only positive year was 2018. So for my low estimates, I'm gonna go still very, very aggressive here, and I'm gonna be very optimistic. And I'm gonna go minus 2% here, which is very optimistic based on what has been happening. And I'm gonna go 0 and 2. Now again, this is very optimistic. This may not happen, and we're going to use this for our first project, for our initial projections here, regardless. So the net income margin is again in the minus. We saw some cases where it was 0.41 and 4.43. I'm gonna go a little bit more aggressive here as well, because if everything is in the minus, we're not gonna be getting a positive price to pay at all. It's gonna be a zero, because we're not gonna be producing free cash flows in the future. And the free cash flow margin, it was good, pretty good actually here in 2017 and 18. Then it went negative, then negative in 2021, but positive in 2020. I'm gonna go maybe, let's just say 50, 60 and 70, which again is pretty positive for the company. And an annual return of 13% is the typical thing. Actually, here I normally probably want to be making 15%, because this is much more risk here for a company of that sort, based on the numbers that they are doing. I have more risk, so I want to be making more money, and so I'm gonna use 15% here instead of my usual 13. I'm gonna calculate here, and you are seeing that our low estimates are basically what I said, close to 0 or 0. This is probably some sense, really. Our medium estimates at 4.62, and our high ones are at 11.75. And the current stock price is way more than that. And so you can see that even using some confident estimates here, I'm still getting values that are close to 0 or $5 or $10. And some of you, especially those that are invested in the company, may feel bad about it, but it is what it is based on the company's financials. It's mathematics, and I go by these models because they provide a very good line in the sand for me to know what makes sense to pay for a company. Because at the very end, what is an investment? It is all the money that the company will be making in the future, discounted for today. That's what it is, because you're not gaining ownership of the Gamestop shops. You're not gaining ownership of their equipment or their stores, nothing of that sort. You are getting ownership of the free cash flow that they will be producing. That's what you get as a stockholder. This is very important to understand. That's the only asset that you really get as a stockholder. So you want this to be increasing, and increasing nicely year over year. And this is what we're doing with this tool. This is why it really helps us. It can really help us with making sound financial decisions here. So that's what I had to say about GameStop. I feel that it's very overpriced right now. But do tell me what you think about it. Are you one of those diamond hands people? Are you holding forever or so? Even if you are, at some point you want to be selling, right? Because the point of investing is making money, not just holding stock. So thank you for watching this video. I hope you enjoyed. If you're not a subscriber and you want and you actually resonate with this kind of content, you may want to become one. And I'd love to see you around. And please also like the video, because that really helps with growing the channel, and then helps me make more videos for you. So thanks for watching this one, and in the meantime, take a look at this video that I made about Alibaba, which is a company that I invested again in for the third time. So thanks for watching, and I'll see you soon. Bye bye.